Okay, I think we're ready to start. Welcome to the 31st statement of the Latin America Shadow Financial Regulatory Committee, long name, and therefore we know each other as CLAF, in Spanish, Comité Latinoamericano de Asuntos Financieros. Just briefly, we are a group of both academicians and former policymakers from the region who meet twice in Washington or in a part of Latin America and prepare statements about an issue that we consider very relevant for the region at the time we meet. This time, we are about 13 to 14 members. And right now, we have a heavy presence of the committee. With me on the table right now are Alberto Carrasquilla, who is a former Minister of Finance in Colombia, Guillermo Calvo, which of course all of you know, now professor in Columbia University, but of course former chief economist at the Inter-American Development Bank, Carmen Reinhardt, a name of herself at Harvard right now, but a long trajectory that is no need to describe. Pedro Carvalho de Melo, former policymaker in Brazil. Jose de Gregorio, who right now, well, about 2 years ago by now, right? Stopped being the former head of the Central Bank of Chile. Sitting right there, just because we don't fit here, are Pablo Guidotti at Universidad de Tela now, but former vice president of the Central Bank of Argentina. Roque Fernandez, also from Argentina and currently teaching at SEMA, and also former both Minister of Finance and President of the Central Bank of Brazil.
Argentina.
Oh, sorry. Argentina.
A bit of confusion.
Too many countries, too many people. And Guillermo Perry, let me start saying that he's from Colombia. And associated also with the Center for Global Development. He's a non-resident fellow here, but the former Minister of Finance in Colombia and many other ministers too. I am Liliana Rojas Suarez, here senior fellow at the center and chair of the committee. Okay, a long introduction. The way we're going to proceed is I'm going to present the statement first. I guess you all have copies of it. So I'll try to be as fast as possible. And then I'll ask my colleagues to complement whatever they think is due. And then the whole idea is to have a conversation with you. So please free to address questions. And we are going to interact not only with the ones on the table, but also with the ones that are sitting right there. OK. So for those of you that have been following CLAF, you know that we've been monitoring risks for Latin America in our recent statements that have been deriving from the global financial crisis. And we've been, over the last few years, assessing the problems and challenges for the region that came from the crisis itself, from the low interest rates in the United States, from the European crisis. And now we consider that it's important for us to discuss with you what are the challenges that a potential and quite plausible slowdown in China's economic growth is going to have in the region. So why do we think that there is going to be a slowdown in China's economic growth? Well, there is a number of reasons, but I would say that the two most important are first, that the quality of investment in China has been uneven, which means that it has led to an overcapacity in the real estate and a large increase by local governments in very ambitious, but some of them low productivity infrastructure projects. And this factor by itself could lead to a lower investment ratios and reduced growth prospects. A second very important factor is that the rapid growth in China's investment has been associated with equally rapid increase in domestic credit. There's a measure used by the Chinese authority that is called the social financing, which is a complex measure that includes sources of funding by Chinese non-state entities, which means individuals and corporations, that includes not only credit but corporate bonds and some form of equity. If we look at that, at the evolution of that concept, it has moved from 120% of GDP in 2008 to over 200% in 2014. Now, we are aware that a significant portion of that increase came from the domestic banking system. But increasingly, credit has been channeled through trusts and other unregulated vehicles, which are usually termed as the shadow banking system. So the way that we see it is that the combination of a rapid credit boom with low productivity investments, so those two factors combined, has raised the fragility of the financial system in China. That's on the asset side. What about on the liability side of the financial system? Well, there were, as most of you know, ceilings on the interest rate that gave incentives for the expansion of these unregulated financial institutions, the so-called shadow banking that I have just mentioned to you. Now, the authorities, very aware of this problem, and in order to increase competition in the financial system, are considering removing such ceilings on deposit interest rates. However, even if that is done, a problem or a challenge that we see is that if banks find their funding sources more expensive because interest rates on the liability side on deposits is going to increase, then that could result in the further deterioration of the balance sheets in the financial sector. So this is in a way the framework. We are not specialists in China, right? We are specialists in Latin America. So this is the assessment that we have on what's happening in China on a very condensed form. But what we believe is that this environment that I have just described to you is going to that actually lead to a contraction in growth, which in turn would lead to a contraction and a slowdown in the, credit in China. And those factors might have important effects on Latin America. And what we have done is to identify those channels of transmission. And as you can see in the paper, the note, it's a little bit long, actually. I mean, we usually produce statements that are a bit shorter. But we have identified, and I'm going to go very briefly through them because we can have a discussion on them. But we have identified four channels of contagion. The first one is, of course, what you would all expect, right? Commodity prices. As you know, South America has been a net exporter of primary commodities, and the numbers are astonishing, right? For 2012, we have that for Venezuela. If you just look at the sum of agriculture, fuel, and mineral exports, so the sum of commodities, that ratio of commodities over total export in Venezuela is 97%, is 84% in Chile, 78% in Colombia, and so on and so forth, right? Brazil is also heavily dependent on the commodity export, but are less concentrated than the others in terms of they have a more diversified basket of exports of commodity exports. Now, China imports of primary commodities, as you know too, it increased significantly during the last decade, and that led and contributed to a significant increase in commodity prices. That, of course, had significant benefits for the region as the terms of trade improved. However, since the middle of 2011, commodity prices have softened, right? They have declined, And partly, of course, has been associated with the slowdown in China growth. And we believe that if that slowdown in China is going to exacerbate even further, then the trend of deterioration in commodity prices is going to continue. How will this affect countries? Well, we spent a significant time among the committee members discussing the different countries and the channels in which this effect on commodities is going to affect each country depends significantly and depends on many factors. However, regardless of what the channels are, what we think is that first, governments that are reliant or depend on revenues from commodities may need to adjust in order to maintain fiscal sustainability. So there's going to be a fiscal impact on a number of countries in the region. Second, well, as you know, every time that there are pressures on terms of trade that have some adverse consequence on exporters, then authorities face pressures to subsidize the affected commodity producing sectors. And so the countries are going to have to face this challenge. Also, something that always gets into the region is the contingent liabilities that governments have associated with the outstanding debt of commodity producers. In this particular case, and because we're talking about China, this contingent liability of government is associated with the outstanding debt of commodity producers. In other occasions, the outstanding debt has been, for the government, has been the contingent liability of the government have been associated with, say, increased indebtedness of other sectors or problems in the banking sector. In this particular case, we are more concerned about the outstanding debt of commodity producers. A second channel, and a very important one, is that, as you know, since for a long period for the region, since 2004 to now, there has been no major crisis in Latin America. And Latin America shone with bright colors during the global financial crisis. And partly because of the improved in economic policies, but also partly because the very low environment of very low interest rates environment in the world, and the fact that the rest of the world, the rest of developed advanced economies were not growing, basically. The search for yield led many investors to actually reassess their portfolios towards emerging markets. So there has been a long period where there is this perception that Latin America and the emerging market class in general is not doing well, not only on its own, but also because external conditions are conducive to directing investments towards that region. Our concern is that China also has been among the countries that are considered as the stars, right? The high recipients of this group of emerging market economies. If something were to occur with China growth, significant decline in China growth, that would lead to a reassessment of risk. We think that the reassessment of risk of the emerging market class is going to be affected. Like, investors are going to have a perception not only that China is having problems, but also, oh, okay, wait a second, let's reassess the whole class. And actually that has been confirmed in a number of occasions, especially as you recall recently, there was this call or identification of the countries called the Fragile Five, for example, right? That were Brazil, India, Indonesia, South Africa, and Turkey, that start, countries from different regions that had started having some problems in terms of inflation, overvaluation of currencies. But in addition to that, that was combined with the announcement of the tapering of, And so the initial expectation that interest rates in the United States were going to increase, and that led to a decline in the rate of growth of capital inflows to emerging markets. So we are concerned that the events in China could actually lead to a more broader reassessment of risk on the emerging market class. And of course, Latin America, this contagion effect, Latin America would be severely affected by that reassessment. A third channel is foreign direct investment. It has grown significantly in the region and actually has been quite good because it has provided a boost of growth to the region. The recipient countries has been mostly Argentina, Brazil, Peru to a less extent Ecuador and Mexico, concentrated in certain industries like agriculture, energy, and mining, but also telecommunications, autos, and railroads. Most recently, however, and that's when this committee starts paying more attention, Chinese investment have also started in the banking sector, especially in some countries, and through the purchase of medium-sized banks in Argentina and Brazil. This purchase by Chinese banks, the Chinese bank involved, have been large banks. Now, in the world of uncertainty of China growth that I have just discussed, the question is what is going to happen with foreign direct investment from China to Latin America? And it's not clear. It's not clear, and the committee had a long discussion about different potential scenarios of what could happen. And we present for your consideration two of them, right? One scenario is that the slowdown in domestic investment in China may lead to an increase in the current account surplus, in which case, of course, that surplus has to go somewhere, and the somewhere could be through a more strategic foreign direct investment into sectors that start becoming more attractive for the Chinese in the context of lower commodity prices. So in that case, actually foreign direct investment to Latin America may actually increase. However, alternative, the decline in investment could be more generalized. And the Chinese might decide that this is going to, their willingness to invest would be less, not only domestically, but externally. And in this scenario, basically the slowdown in China will have recessionary pressures on the overall economy, because in that scenario, we see a decline in foreign direct investment. An additional channel that we considered, and we call it an emerging financial links via Chinese banks. I'm going to go quickly about this because this is just emerging. It's still not very large. The links are important, but the numbers, when we assess the numbers, are not still that large. Basically, Chinese bank, as I had just mentioned to you, have started to enter the financial system in Latin America. But the numbers, as I just said, are relatively small. Now, everything constant, is expected that this could expand in the future. The good news about this is that the performance or this trend could actually be a positive development, since it provides trade financing for the region, and therefore it actually helps to smooth financing cycles that Latin America could face. However, we like to raise the awareness of regulators in the region of the potential spillovers of the financial fragilities in China that I have just discussed. We know, not from China, but from other banks, not the Spaniard banks, but other European banks, that during the international crisis, some international banks used their branches and subsidiaries in the region, in Latin America, to channel funds to their headquarters to mitigate the effects of the credit crunch that they were suffered in the advanced economies. So a similar situation could occur in the case of China if problems accelerate. Now, again, I like to stress that the numbers are still too small. This is just a call for raising awareness on the issue, not that is right now a big reversal. Also, financial links between China and Latin America have increased at the official level. You know that in September 2013, there was established this BRICS liquidity fund to start implementation in 2015. And the most important contributor of the 100 billion liquidity fund is China with 41 billion. In addition to that, and in particular with the region, central banks in Argentina and Brazil have set up swap agreements in domestic currency with the People's Bank of China. And again, the purpose of these agreements is to complement the role of other multilaterals to provide liquidity, external funding, in case of episodes of turbulence in international capital markets. These initiatives are new, they are still untested, and may actually play a beneficial role. We just want to put it on the table. We don't know yet about how this evolves because we're talking about small numbers. So, facing these new risks for the region, what does the committee think in terms of policy recommendations? Well, we would like to recommend a two-step approach that could help adopt precautionary policies in the countries and to help international financial institutions to be prepared to help in case these problems were to materialize more severely. In the first instance, as a first step, countries should prepare and release in a transparent way a series of stress tests of financial, fiscal, and external vulnerability that comes from both changes in commodity prices and financial disruptions. Remember that we are adding the China factor to the other events that are happening in the world, including the forthcoming global liquidity tightening that will eventually be associated with the increase in interest rates in the US. So this is an add-on factor to what is forming the international environment. And so we would like this stress test first because we see an urgency of this to be done. We want them to be done at the country level and with as much transparency as possible. But over the medium term, we think that this would be much more useful. This stress test would be more useful if they are performed in a coordinated way by countries with a common framework and with the support of the multilateral organizations, and in particular, both global and regional, but in particular by the International Monetary Fund. We think there is a real need to put the whole picture together. I mean, the world is getting complex from what is happening in industrial countries, so emerging markets have to be also prepared for that. And but at this stage, people don't even know. I mean, what is it? I mean, what exactly is the number? What is the potential for these effects to the particular effects that are going to happen on the fiscal sectors of countries, on the external sector, and so on. Now, because of this is a recommendation that this is not the first time that we pose, but every time we produce a statement on the risks for Latin America that come from the international environment, we come to the same conclusion. And is that in light of this mounting risk, the IMF needs to strengthen its effort to be able to act as a lender, as international lender of last resort. And we like to add our voices to those that said that it is the time now to recapitalize the IMF. Now, when the risk assessed in this and in other statements that we have produced have not yet fully materialized. If the IMF does not get recapitalized, well, any emergency financing facilities that it produces will not have sufficient credibility, and the world needs this lender of last resort. Now, as long as the IMF does not become or does not function as a lender of last resort, it's natural that the region needs to put more efforts on building and maintaining their own external liquidity. And of course, they've been doing that through the accumulation of international reserves. But we also think that the need of the role of regional multilateral organizations that provide liquidity, like the FLAR, Fondo Latinoamericano de Reserva, could have a role. We have produced a statement that says about how this small fund can actually be recapitalized, and we could add more countries into that. It's no time to discuss that, but regional efforts need to be taken in that direction. And of course, there is no way that we can finalize our statement without stressing the importance of what some countries in the region are doing and continue to be doing, which is the need for strong fiscal and monetary policies and for allowing for exchange rate flexibility. Many people may think, oh yes, it's easy to say. No, first of all, it's not easy. It's easy to say, but it's difficult to perform. And the number of countries in the region actually are having serious problems now. A few countries are very strong. And to end my presentation with a very positive note is reassuring that some of the countries that actually are the most exposed to the risk from China are actually the best prepared. And two of those examples are Chile and Peru. All right. So I'm sure that I left so many things out. I'm sure that my colleagues may be thinking, she should have said this, not that. So why don't we give them the opportunity, and anyone that would like to complement, correct, add, or... Oh, thank you so much. You see, I already forgot to mention something very important, and is that we had two more members participating in this, Ernesto Talvi from Brookings, and Laura Alfaro. She was the Minister of Planning? Trade in Costa Rica, and now is a professor at Harvard. So they were here until yesterday evening with us, but you know how many were already, so we're in shape. Thank you, Pablo. Please. Guillermo.
Okay. No, I don't disagree with you.
Good. Yeah, because this is important to clarify. This committee, we have different positions, okay? It's not that we all agree in our views continuously. We reached an agreement in the statement, but there's tension sometimes, which are actually, from our perspective, very healthy.
Well, you stopped me too soon. I don't disagree with you.
But
no, more seriously, no. I think just a few words about China, because in discussing this case, I learned a lot, and there are certain things which are really remarkable about the Chinese experience. As everybody knows, they implemented a very large Keynesian-inspired stimulus package in 2008, and that was applauded by the world because it was very timely and, to some extent, very successful. Now, what's interesting about this experiment is, number one, that it took the form of a very large increase in investment. That's very unusual. Because investment projects are not easy to come up with in the spur of the moment. However, apparently they had these shovel-ready projects. that they, some of them good, but apparently many of them just good for the popularity of local politicians. So the increase was substantial, about 10 percentage points of GDP in a very short span of time. And you don't see the same rise in consumption as it is normally the case when you go through these stimulus packages, you implement this kind of stimulus packages. So as a result, investment now is about 50% of GDP. That's really sky high. And once again, the quality of the marginal investments is questionable. Now, the challenge for China, I think, which is fully recognized in the discussions within China, is to recompose, to change the balance between investment and consumption. So that's one issue that stands by itself independently of the financial consideration. See, that was well understood. Now, the transition from less investment and more consumption from the situation that we are now can in principle be handled in an orderly fashion. It may not be easy, but for an economy which is managed from the top, like the Chinese economy, one would expect that one wouldn't be too worried about it. So I think this is just to emphasize the point that the committee, which we are always focusing on financial issues, we started to get really concerned when we realized that there was this very sharp growth also in these unregulated banks that now represents about 30% of total lending in China. So it's large, it's unregulated, the central bank doesn't know much about it. Well, all kinds of rumors are circulating, but what one is immediately concerned is that maybe these are financing projects that are of dubious quality, number one, and if there is a problem, the central bank doesn't have the information. So it will take a while until they know exactly what happened. And in the meantime, when you have these kinds of shocks, we are very concerned that that may lead to a sharp cut, at least transitorily, of credit flows. That's what we call sudden stop. And our experience in emerging markets, that's what really made a big difference in this crisis. I mean, it made it very deep, much deeper. So that's the only point that I wanted to emphasize, to show that this is kind of adds one new element, a financial element, which we think make the situation, opens up the possibility that instead of a gradual slowdown, that the rest of the world can adjust slowly, maybe painfully, but not in a really dramatic way. It may turn out to be something which just happens overnight and is much more difficult to accommodate.
Alberto, do you want to add something?
Yes, I would say that a very important point that we made during the discussions is, contrary to the name, we are a financial committee, and we began to discuss financial issues and so forth. But really, the statement and the points that are highlighted that were highlighted in our discussion were real effects derived from two kinds of problems. One is the rebalancing that Guillermo just mentioned in the 5-year plan, and the Chinese authorities have been very, very explicit in stating this as a goal, that the composition of total expenditures in the economy should be shifted. International organizations have been discussing with the Chinese authorities the desirability for the global economy for this rebalancing to take place, and that is one of the two forces that can shape the discussion. And the other one is the slowdown in growth. derive from the fact that probably the marginal investment is of lower quality than the average investment in the country, and that this marginal effect, the effect of decreasing quality of investments, may be a factor that slows growth, and that has implications for Latin America. So the discussion, I will emphasize the importance that the slowdown in growth, the growth which has been gradual so far, but that we discussed possibilities in which it would not be so gradual going forward, is to us the fundamental topic, at least within a window of 2 or 3 years time.
Carmen.
Well, what I'd like to do is complement what has been said in 2 areas. First, actually, let me start with the policy recommendation. A clarifying point. Stress tests are typically understood to be an exercise performed on banks. What we are suggesting, recommending, is something much more comprehensive, involving the banks, the fiscal finances, and the external accounts. And the specific type of stress test that we have in mind is one which importantly considers what would our finances in all these dimensions look like if commodity prices were X% lower and then X% lower. As Liliana pointed out in our statement, we've highlighted that the real channel that is extremely important for a number of countries, particularly in South America, is a commodity price channel. And therefore, in the last few years, in which we had, up until somewhere in 2011, early 2012, we had seen very, by historic standard, very robust and rapidly rising commodity prices. A reversal of that is going to have repercussions, big repercussions on the fiscal. It's not just on the impacts on revenue, but also the fact that we don't always know to what extent contingent liabilities have been accumulated during the bonanza or the boom years. And so the kinds of stress tests that we are recommending in short order, the short-term recommendation, if you will, is a very comprehensive exercise with that particular focus in mind. The second point that I wanted to highlight is on the external environment. In the previous statement, we addressed a lot of the issues surrounding the very momentous announcement by the Fed of QE tapering. And just to recall the laundry list of external factors that were working in the favor of emerging markets in general and Latin America in particular, they involved low and stable and declining international interest rates, high and booming commodity prices, robust growth in China and its implications for FDI in the region, and the fact that emerging Europe was imploding, not declining, but imploding, which meant that capital, importantly, was reshuffled and emerging markets emerged as a much stronger asset class. And in effect, you see this in the convergence of ratings. Ratings in the advanced economies were coming down at the same time ratings for emerging markets and Latin American countries were rising. Where we are now, as I said in our previous statement, we dealt with the issue of the fact that the interest rate environment is not likely to be as conducive to the emerging markets in Latin America being as attractive an asset class. Interest rates may or may not rise a lot, but the point is that the very big monetary stimulus lies behind us, not ahead of us, in all likely scenarios. We've now highlighted here the risks associated with China slowing and its impact on commodity markets. And I would like to add something that is in the statement, that periphery Europe has been stabilizing. We're not talking about necessarily any kind of recovery or debt crisis resolution or anything that ambitious, but it has been stabilizing. And therefore, a lot of the capital that also flowed out from periphery Europe into emerging markets is in varying degrees returning to Europe. And so the worsening in the external conditions taken together with the aftermath of a long capital flow boom, a lot of additional vulnerabilities, larger current account deficits, higher credit levels, and so on, the combination of somewhat weaker domestic factors against this less hospitable, if not outright hostile, that I think would be an overstatement, but less hospitable external environment raises a lot of risks about hidden problems in the fiscal accounts or hidden problems in the external accounts that may not have surfaced before.
Thank you. Pepe, you want to add something?
No, I'm
Not
familiar
right now?
with the statement.
Anyone? No? All right. Okay, so why don't we open for a conversation? Okay, if you can identify yourself, and we'll take some questions. We have time for a couple of rounds, so if you identify yourself and ask the question, please.
Hi, I'm Eric Ramos from the International Monetary Fund, and I would like to ask if you think this model of subsidiary is enough to stop this capital outflows that you were mentioning. I mean, how are you evaluating the strength of this model versus the branching model? You mentioned that there could be some money coming out of the banks. For example, trade financing may dry up. So do you evaluate this as a good backstop, this model of subsidiaries versus branches in China?
Okay, please, sorry.
Heather Scout with Market News International. On the stress test, has there been a model of the kind of stress test which you are advocating used before to success? And also, how do you rate weight the risk that you see from China compared to slowing versus recovery in Europe, the tapering in the U.S., the sluggish recovery in the U.S., et cetera? Which of those factors is more important for Latin America, and is this the China risk a growing factor?
Okay, we can take a couple of more questions right now, right there.
Yeah, Alejandro Izquierdo from IDB. The committee discussed the issue of shadow banking and the risks that may emerge from their dubious lending. Now, usually the shadow banks are very much linked to the formal financial system.
Yes.
What are the risks that the committee expects may enter the formal financial system, and how much do you think the central bank is prepared to deal with those?
Thank you. A question here, just a second.
Thank you. David Rodriguez, and I want to ask about contingent liabilities. One thing is a contingent liability in the banking sector, where it may have economy-wide impact. But why agriculture produces a contingent liability? It seems to me that in Argentina, at least, the government will be very happy to see the agriculture producers getting hit.
Okay. There's one more question here.
First, I'd like to congratulate
identify
Mario
yourself.
Rieti. I am from the Continental Group in Honduras. I'm a former president of the Latin American Bank Federation, FELABAN. I am the author of the first book on money and banking in Latin America, published by Prager a long time ago, when I was executive director of the Inter-American Development Bank. It's a long story, but anyway, I'd like to congratulate the committee, Liliana and Maria Cecilia Ramirez, for the statement. I agree. What is important in this statement is to look at the financial transparency. Financial transparency is the key issue in the whole thing. And this is a problem because we lack financial transparency in some countries of Latin America and also in China. When you're taking by China, are you taking about Taiwan also? Only Hong Kong and China? This is my first question. Because Taiwan, the report, I wrote a book on successful development strategies of the Taiwan, and there is a lot of things that we can put on this if you take the case of Taiwan. And finally, I like to recommend that you take into account the work that Robert Kaplan is doing on China. Robert Kaplan is now, I think, is on China, but he's doing a marvelous job. I saw some of the presentation, and he can give some recommendation about the real structure of the BRICS, the role of China, and especially what China is becoming, a new model of economic development in the world, following the example of Dr. Sun Yat-sen, who was the founding father of China a long time ago. Dr. Sun Yat-sen had 3 principles of the people: nationalism, democracy, and social well-being. We have to take this because in Latin America, we have to put more emphasis on equity, in equity financing also, and especially, and this is what is important, to give a better distribution of income. Thank you very much.
Thank you.
I'm sorry.
Lawrence?
Lawrence McDonald here at the center. A follow-up to the previous speaker, are you recommending that the results of these stress tests be made public? And then also a clarification, though it's a bit beyond the realm of your statement. You call for recapitalization of the IMF. Do you have an estimate of what its lending capability is now and what you would consider an appropriate level of recapitalization? Thank you.
Okay, let's stop there for the first. I know there are more questions, but to allow, some discussion. I know that Pepo would like to answer something on the stress test.
Yeah, I would like to make 2 comments, and this is, of course, it's not we went so deep in the discussion, and I'm not sure whether your issues, the first question about subsidiaries and branching in international banking is an issue for China or for Latin America. Now, for Latin America, personally, I am a strong supporter of subsidiaries. If you see the evidence during the crisis, at the peak of the crisis, the outflows from Asia were much bigger than in Latin America. And one reason, perhaps, and even with Eastern Europe, was the fact that there was subsidiaries. Now, from a regulatory point of view, you can make very similar branches and subsidiaries. So at the end, that they don't make that much difference, and because you can allow, first, you have to be very strong in terms of related lending, in terms of deposit in their home country, in terms of the level of capital, and so you can have a very make branches and subsidiaries look like a domestic bank. I think that one difference, and this is the experience in the case of Chile, is that subsidiaries have their own board. And that's quite important because you have your own local board, generally, that is responsible for all the activities of the bank. So I think that it's a matter of regulation, but I think that subsidiaries have been not the panacea, but it helps, at least from a point of view of corporate governance. Stress test, there's a couple of points, and I think that Carmen was very clear. Regarding the stress test, in terms of financial system, we have the experience in the US, in Europe. What was the problem? If you see that the concern that markets have is how credible are these stress tests, and so transparency is quite important in terms of understanding the models, what's behind, at least to give credibility to the stress test. We always can do a black box and put some shock and get out and take out some output that is kind of favorable for the country. So the one you need at least to make the black box transparent, and I think that's quite important. Now, what has been done, it has to be comprehensive in terms of you don't need just to focus on financial. And I have to clarify that most countries in Latin America with financial stability report, they have already stress tests. The issue is to put them on a more common framework to which kind of shocks you want to put into the system, and this is what you to have a more standardized approach. Now, this is just one part. The other part, and this has been done to some extent at the IMF, but also should be done more strongly, is the sustainability of public finance, which is quite important because this hasn't been that internal in the countries, which is a sort of the stress test to the public sector, because we know that in most of the region, the revenues coming from commodities are quite important. So one of the things is that despite, and this was also, you can say, the financial system in relative terms with other emerging markets in Latin America have been relatively strong. There is a much more, in my view, uncertainties about the strength of public finance across the region, and we should be very clear about what are the potential imbalances and risks for fiscal sustainability.
Pablo.
Thank you. First of all, on the issue, I don't know if I got right the question on branches and subsidiaries, but I tend to agree with what Jose was saying, in the sense that in Latin America, although there might be some advantage of subsidiaries, largely regulators treat subsidiaries and branches the same in terms of capital requirement or any other regulation. So in this sense, the difference is not that significant. In terms of the Chinese investments in the banking system, is still very small and not clear what the strategy is, although they seem to have a similar strategy everywhere, even in the US, that is essentially entering through some medium-sized banks, and the indications that we have is that, for instance, after the investment in Brazil, the banks probably will try to move to Chile, Peru, Colombia. So, and we discussed a little bit the implications of that. Certainly, what we are seeing in Brazil is that, for instance, the plan of their activities is shifting out of small and medium enterprises and moving more towards trade finance. We expect that they will probably support Chinese companies in all the foreign direct investment that they are doing in the region, and it makes sense also as a way of hedging political risk and the regional risk of these investments. And of course, the striking fact about these banks is that they are very, very large. In fact, I understand that the CCBC that invested in Brazil has assets equivalent to the entire assets of the Brazilian financial system, okay? So it's simply an issue that, given that it is small and does not pose major risks now, but it's something that probably will be a challenge for regulators in terms of how to provide authorizations and how to eventually regulate and deal with potential risks from these institutions. In terms of what Alejandro was asking regarding the sort of the risks of the formal or the traditional banking system, we discussed a little bit of how we saw, or we foresee in a certain sense, the resolution of financial fragilities in China. And certainly we ruled out sort of a Latin type of banking crisis in which you have depositors running against institutions. What we understand is that the deposit base is stable, and people have confidence in institutions. However, the typical reaction of financial institutions when risk accumulates is really that they become extremely prudent and they stop lending. Okay, and in fact, the regulatory response of trying to limit the growth of shadow banking and try to tighten regulations in the traditional banks may in fact increase this attitude of stop lending and try to accumulate liquidity. So in a certain sense, I would say probably the most likely scenario that we expect is a relatively slow digestion of financial fragilities, which has the implication of probably a more protracted slowing down of growth. And this has essentially what we were saying is this is a major development, because a few years ago we were looking at the locomotive of the world economy as China, and now suddenly maybe we are going to have to live with one locomotive less, and that has strong implications. Okay.
Yeah, and just to add a bit from our discussion to what Pablo just said regarding Alejandro's question, even if the government was going to bail out the banks and because it has the resources, and there is a slowdown in credit from domestic banks, but even if the government makes up for that through the wrong channeling of public banks to extend credit to offset the domestic credit, still we have a problem, because we have started talking about that the marginal investment were low productivity. So where are the investments that you're going to put your money on? So the problem itself of kind of non-performing assets might be increasing even more. So you can delay the resolution or the eruption of the problem itself, but still there is the problem. Carmen, you wanted to say something.
On the question of contingent liabilities, I would say there's two parts. One is it's very country specific. This is not a hedged answer to what you raised, but there are two reasons why contingent liabilities would be an issue. Sometimes the enterprises involved in commodity production are quasi-fiscal, quasi-public. The line between what is private and what is public is not well defined, and there are off-balance sheet items that typically surface during bad times. So there is the issue of where the border between what is public and what is private. Second, you make the point that very understandably that contingent liabilities, if it involves the banks, are an issue, but if it involves corporates, it's less clear cut. Let me point out that when Korea in 1997 was faced with a potential default of its corporates on external debt, it bailed out everybody. It went beyond banks into corporate, so it's a very country-specific type of response. Secondly, one of the reasons we're calling for the stress test is just to also get a sense to what extent bank lending itself has not involved commodity-linked loans during the boom. On the issue of withdrawals, the gentleman from the IMF and the stress tests and the relative weights of whether China risks are more important than tapering, or whether the European risks. Look, the fundamental issue, and Paulo definitely addressed this in these comments, is the scenario that we have laid out here as a baseline is not one that involves big negative surprises. Okay? When a surprise occurs, that is, a crisis occurs, contagion is fast and furious, and what we are envisioning here would probably be a tip of the iceberg. If, however, what we are talking about is a more drawn-out spillover effect, absent surprises, then I think the issue of withdrawals, sudden withdrawals, is less pressing. I've done a lot of work on types of contagious episodes, and the fast and furious variety of contagion that we have seen in some crises like in Asia, like in Russia, has involved elements of surprise, which can always, of course, happen. And that goes to your question of weights. I don't think that if you look at QE tapering, the Fed could always really surprise us and tell us they really need to raise rates a lot faster and by a lot more. But that is also something not factored into our discussions here and then. And lastly, I'd like to, on the question of stress tests, and has anything else been said on stress tests of the kind we're proposing? One of the members of the committee who is not here, Ernesto Talvi and Alejandro Izquierdo, have also done work in the Inter-American Development Bank, looking at the sensitivity of external and fiscal accounts to commodity prices in particular. And so that is one type of analysis that is certainly very germane to what we're suggesting here.
Guillermo Perry.
One comment on the stress test is we are recommending from the technical point of view, not only that the stress test look at the financial system, the fiscal system, and external accounts, but it looks at the potentially combined effects of a rapid slowdown in China and a sharpened reduction in global liquidity. Because if the two things happen at the same time, the consequences may be much more serious. The second thing is that the reason for suggesting this is that there may be some countries that are somewhat more prepared, and we point out two of them that clearly have built up cushions of liquidity, fiscal surpluses, and other things that would make the reaction easier. But we know that many of the countries have not done that. And at least pressing them to begin to think harder on this issue may be an important topic. But more important towards the future is what Pepo said, that we really need to get some coordination of these things going on. Because not only because countries are not islands, they are related together, so you would like to have a coordinated approach and look at the effects of one over the others. But because of the fact that you want to make sure that these things are done in a serious way. Some countries will do them by themselves in a serious way, some others are not. And the consequence of preventing this are important not only for the countries, but for the multilaterals. Because otherwise, the day after tomorrow, you have a serious problem, and nobody really knows what is going to come to the door. So we are not saying that we are seeing a catastrophic thing happening, but clearly the risks have been on the increase, and we still have time probably to do these things, to work them in a more orderly fashion. A small comment on the contingent liabilities. No, the problem is that in these past 10 years, there are sectors that have looked so good that probably everybody have lent to them in excess, that probably some of them have done silly investments. No, when in the very good times is when you do these kind of things. You overstretch yourself, you over-indebt yourself, and public banks are behind a lot of the support of some of these sectors. So you may have some more contingent liabilities, or you may not, but that's what the assessment has to rely. And even when it's purely private, I just want to mention a case. We Colombians never thought that we would see at some moment public support bailing out of the coffee producers that were our stellar competitive sector. But in 2009, we did spend, because of political pressures, a significant bailout of coffee producers. So So it may be true that in Argentina they let the producers go bankrupt, but this may not be the case everywhere. So that's something in addition that must be taken into account in the case of a very dramatic scenario, which we hope it won't happen.
Guillermo.
Yeah, no, just a small point about stress tests and the weights that we give to one shock vis-a-vis another shock. I think we have to be very careful because it's not probabilities ex ante of certain shocks. Of course, it's always good to keep in mind, but that's always very hard to establish, right? But even if you do, that doesn't imply, for example, that you should give more weight to something that is more likely to happen. This point came up in what Carmen said, because what really hurts for the financial sector is what you didn't expect. So surprises are very bad news. So, for example, if we expect that China is going to adjust gradually, which is our baseline scenario, well, that could not be. That doesn't necessarily mean that the situation is positive. But if it is well understood and it is expected, there is time to adjust, right? But if all of a sudden there is a blow up of the shadow banking system in China and that brings about the stop of credit, even though we think that that's unlikely, that's something that the policymaker cannot discount. So one can do this analysis of stress tests without paying too much attention to probabilities. In fact, if anything, give more attention to small probability events that have very large effects. These are vulnerability for which you should be prepared. So we have I mention this because there is a tendency in policy making sometimes to discount certain things because they are low probability. Well, precisely, those are perhaps the most dangerous.
Yeah, to Lawrence, to answer your question, no, we did not make estimations for the size of recapitalization of the IMF. I can only give you two facts of discussions in the committee during the global financial crisis. The first one is that one very important line of credit of the IMF, the flexible credit line, we estimated that if all the countries that would meet the criteria for qualification were actually going to go to the IMF and says, okay, I like the credit line, there would not be money at the IMF to actually meet the request. And the second observation is that in one of our statements during the crisis, we estimated that for Latin America only, if the crisis were to persist, the IMF could need an additional $200 billion. That was for Latin America at the time of the crisis. So that's all we have really done. We have time for a couple of more questions. I see a couple of hands raising, so maybe we can, okay. Yes, please.
So whether the stress test should be publicly disclosed?
Absolutely, the answer is yes to that. Yes.
Did you take Taiwan?
Taiwan, no. No, it's not part of, it's, no.
For Central America, Taiwan is very important.
Jaime de Pineda.
Taking care of the Central American financial system.
Yeah, okay, please.
Jaime de Pineda from the World Bank. We've done a little bit of what you've already indicated in the last regional report where we've tried to assess the exposures in the region to the two kinds of shocks, the commodity shocks and the financial tightening conditions, and looking at the China situation as well. One thing that struck, and very much in line with what Mr. Perry was saying just a moment ago, is that there are differences in the countries involved between exposure and vulnerability. There's this middle ground, which is policy reaction capability. And there are countries in Latin America that can do a good deal more than others. However, as we've assessed the situation from 2008 to today, most of those cushions are much weaker than they were in the past. So this is a conditioning factor with one or two exceptions. Bolivia is a case in point which is even stronger today than it was a few years ago, but most others are weaker.
Okay, thank you. There was a question right here.
Sikander Daranani from the Inter-American Development Bank. You mentioned the role of the IMF to play the role of a lender of last resort. What should be the role for the other two multilaterals in Washington, the World Bank and the IDB, in containing such a potential crisis? Thank you.
And there is another right there. Yeah.
Hi, Todd Martinez from the Institute of International Finance. In calling for these stress tests specifically in relation to public finances, do you think some of the countries are already doing that in the form of cyclically adjusted fiscal balances? Chile's had one for about 15 years, and in recent years, some other countries have proposed them, but it hasn't had much traction in Brazil or Uruguay. So would that be a specific recommendation you might put the weight of the committee behind? Thanks.
Sure. Last call for one more question. Fred?
Fred Jasperson. The latest PMI numbers from China indicate something of a recovery from the bad first quarter. And I'm wondering if the other most recent data suggests that China may be beginning to turn the corner and have stronger growth. Now, this, of course, does not affect in any way the committee's conclusions, because we were concerned, there was concern about the financial system in China, even when China was growing very rapidly, and that continues. Also, I was wondering if Governor De Gregorio could also comment on the role of monetary policy in this world of uncertainty, particularly in countries that are experiencing in Latin America a deceleration of growth.
Okay, why don't we start with you, since there's a direct question?
Let me make a couple of comments to all the comments, but I think that when we emphasize we had a brief discussion on the importance of the first line of defense for all external turmoil is domestic macroeconomic policies. Having a strong financial system and being able to do monetary fiscal policy, letting the exchange rate to play the role of shock absorber is key for anything. And I think that if you want to make some of the big differences between the response of Latin America to the Asian crisis and to the global financial crisis, beyond having a somewhat better external scenario, one has to be fair to say that, it was the reaction of macroeconomic policy. So that's why we also emphasize the need to build the space, it's not just to have a good framework, but also to have the space in order to be able to use monetary policy. And this leads me to the second point. When we talk about fiscal sustainability, and I fully agree, there has been some deterioration in cushions. Now, and that's why it is important in terms of fiscal policy to have a very good, strong stress test, debt sustainability, because there has been some deterioration. Now, it's not that large, but it could be a source of concern to do sort of cyclically adjusted fiscal policy in order to build the cushions, and well, this depends a lot on a country-by-country basis, but today I think that's quite important, especially because one of the main threats from a lower commodity prices is on public finances. So you have a slowdown, a deterioration in public finances, and pressure for more spending. So it could be a quite complicated scenario. Finally, regarding just one point, the latest PMI in China was good, which means that probably the next one will be bad, because this is the way the world is moving, good and bad. Yeah. But there is one thing. Hopefully, the China does well, and this is just in case. We're not. But what we have been seeing, and think that there is an increased risk of this slowing down, which could be for cyclical reasons, which could be aggravated by financial reasons, and I think that the economists, hopefully this does not happen, but economists are well prepared if this takes place. That's a good thing.
Okay.
That's a minor addition to the discussion of the common framework for the stress test. It's going to be very difficult, but I think that a lot of research is very welcome from all the institutions that can do that. And it is not going to be easy, because if we look at some of the problems that we discussed in the committee during these days, is that, for example, in some cases, let's say Argentina and Brazil, the foreign direct investment done by China is sort of not the traditional one that we had in the past. For example, just to jump the tariff protection in the country, so there was a lot of investment to penetrate the market, because country were putting a lot of import restrictions. It's not that way. What happened in the last decade is that China has tried to invest in Argentina and Brazil to make sure that they can get the inputs that they need for the production in China. So if you are going to look at the problem of doing the stress test, and you start to look at, let's compute what is going to be the price elasticity if we consider that commodity prices are going up or down, and what is going to be in the stress test the income elasticity by sector if you are going to consider some of this problem, then you will see that it's going to be totally different what we usually consider. Suppose a very strong slowdown. I would say that the income elasticity of the soybeans import in China is very, very inelastic, in the sense that they will keep importing soybeans independently of the rate of growth of the economy in China. Okay, and maybe the price elasticity is going to be related to what is going to be the impact of the slowdown in the commodity prices all across the globe. So that's something difficult to assess, because it will depend with each product. So what I'm saying is it is not going to be easy, but I think that it's going to be very important to go through those stress tests. And perhaps if all the research community in international organizations or university pay a lot of attention to make public different methodology, I think that that will improve a lot the assessment of this sort of problem, not only in China, but everything that we may have in the future.
Carmen.
Very briefly on the cyclically adjusted budget question. The conventional exercise on cyclically adjusted budgets had its origins in the advanced economies, where services and manufacturers are really driving force, and business cycles are a lot more regular than, of course, excluding last cycle, which has involved a major financial crisis. That is not perhaps the most, without putting it down, but it's not the most informative tool for assessing the potential impact of a commodity price decline in economies that are very commodity dependent. And so to be clear, the stress tests would involve additional elements that are based off scenarios in which commodity prices play a central role. They're not really the same as saying, well, if you have a slowdown in growth as of X, we're dealing with a different industrial structure than the OECD variety.
Thank you. Okay, just to answer your question about the role of other multilateral organizations, the way we see this, and the reason why we mention the IMF, is because we don't see any other institution performing the role of lending of last resort, which is basically you have financing now, immediately, right? I mean, it's provision of liquidity. That doesn't mean, however, that when you have a crisis or you need additional finances, you have a whole new other battery that is related, including at the IMF, with conditionality, other kind of programs. And those programs are usually complemented, the sources of funding, with resources both from the World Bank, the Inter-American Development Bank, and regional institutions, and many others. So it is the length of last resort function that we underscore for the provision of liquidity, but the huge amount of financing that needs to be complemented that for actually putting a program in place comes from the rest of institutions. Okay, we have reached the time for closing. We thank you very much, you for your participation and for the discussion. And we hope to see you during our next statement. Thank you so much to all.